For those students want to do a video where go through the optional test exam questions that I have posted to Brightspace. So I've got the optional test in there, and I've got the answer key to go along with it. Want to go through some of the questions on there. Some of them trying to trip you up a little bit, give you more information than you need. I just want to do a video where I'm kind of walking you through some of the things that I saw. Go ahead and share my screen. And I already did this just to get the answer key. There's not a way just to print it out, so I have to go through answer everything. So I wanted to go through a couple and kind of show you guys some stuff that I saw. Let's start off with question one. The primary objective of the federal income tax is to raise revenue. Where are the secondary objectives? Social and public policy objectives, e.g., encouraging charitable contributions, discouraging illegal bribes. That's true. Economic objectives such as stimulating private investment, reducing unemployment, and mitigating the effects of inflation. That's also true. My gut's telling me it's going to be D, all the above, but let's just go through. Encouraging certain activities such as research and development and small business investment. That's also true. I'm going to go D, all the above. Thinking. Why is a thorough knowledge of sources of tax law so important for a professional person who works in the tax area? Due to the vast volume of tax law sources, it is nearly impossible for any person to have recall knowledge of the entire tax law. Thus, the ability to understand what the relevant sources of tax law are, their relative importance, and where to find the sources are vital to a person working in the tax area. I like that answer. Probably can go with that, but let's go through B and C. There are very few sources of tax law. Not true. It is important for a professional person working in the tax area to understand these sources because the knowledge of sources of tax law is required by most state CPA licensing boards. That's true, but there's a lot of sources of tax law. There are very few sources of tax law. It is important for a professional person working in the tax area to understand these sources because the knowledge of sources of tax law is required to practice before the IRS. Not technically true. You need to either be an EA or CPA. I'm going to go with answer A. Next question. Jill and George are married and file a joint return. They expect to have 490,000 taxable income in the next year and are considering whether to purchase a personal residence that would provide additional tax deductions of $40,000 for mortgage interest and real estate taxes. So what is their marginal tax rate for their purposes of making this decision? So marginal tax rate, go through again. It is the tax rate on the last dollar that you earn. They're at 490,000 of taxable income. That puts them in the 35% bracket. If it's over 462 and it's not over 693, 750. What is the marginal tax rate if the personal residence is purchased? Calculator, and we're going to go 490,000 less our 40,000 of deductions. That's 450,000. Here, that would fall in the 32% bracket. Right. Tax savings if the residence is required. So let's look at our tax for purchase. So tax on the 490,000. 490 less 462,500. Times that by 35%. It's the amount that's over 462,500, but not over the 690%. 5. I'm going to add that to 10564. 115 to 9. Here we've got the 450,000, because this is with the purchase of a residence. Plus 100 times 4.32. Add that to 74,208. 101,664. Total tax savings on the purchase. 13,625. Perfect. On to the next. Yeah. So Keith Thomas and Trent Brooks began a new consulting business on January 1st, 2023. No information. They organized the business as a C corporation, meaning not constituted. KT Incorporated during 2023, the corporation was successful and generated revenues of $2 million. KT had operating expenses of $800,000 before any payments to Keith and Trent. During 23, KT paid dividends to Keith and Trent in the amount of $350,000 each. Assume that Keith's wife earned $130,000 for her job, they filed a joint return, an itemized deduction of $40,000. So begin by calculating the tax liability for KT. Now start with gross income of $2 million. Columns and things will get a loss of minus our operating expenses of $800,000. There is nothing else to compute here, so I'm gonna leave that one to there. Because it's just in gross income and operating expenses. 2. We need to know tax on corporate rate. It should be 21%, but let's just go ahead and verify. So I'm saying we've got taxable income of 1.2 million. One corporate tax of 252,000. Perfect. One, so let's start off with her salary. 30,000. Dividend income, and that was 350,000 piece. Here. 50,000. Up. Perfect. Let's see. We take our total taxable income. I'm gonna back off the dividends. We've got 90,000. That falls in the 22% bracket, just barely, but that's 20% added to our now that rate. Taking the amount over 89,450 times 22%. 550, that's plus the 10,000 tax is 10,400. So, the qualified tax rate is 15%. Uh, I'm not gonna go through this one again. Um, Pretty important what they'll be changed here. Um, Instead of organizing the consulting business as a C corporation, assume Key will Trent organize the business as a limited liability company, KT LLC. KT made a distribution of 350,000. Keep and Trent in 23. That's different than dividend. Compute the total tax liability of KT LLC and keep 23, one additional tax on net investment income and ignore the qualified business income deduction. So, assuming the facts are still the same, the gross income of 2 million. They didn't change anything, they just changed the entity type, which is important to see. The operating expenses that were 800,000. 2 million again. This is where it gets important. Corporate tax, pass through entity, can be 0. To compute the tax liability of Key for 23. So now he's got the pass through, and it doesn't tell you this, but I'm assuming Key is 50%. He operates this with one other person. So this 1.2 million, it's not allocated to both of them, it's allocated 50% each. So the income that Keith recognizes should be 600,000. Still, the 130 is white print. Salary gives us total AGI of 730,000. Deduction 40. Thousand. We don't have dividends because that's corporation. 1,000 minus or 462,500 because that's the bracket. That by 0.35. That was 105, 66, 185, 280. Tax on dividends. You don't have tax on dividends because you never received dividends. You got a distribution, which is different. Unless he took distributions in excess of his basis, it's not taxed. If he takes distributions in excess of basis, then it becomes taxed. Charlotte pays $8,000 in tax deductible property taxes. Charlotte's marginal tax rate is 24%, effective tax rate is 20%, the average rate is 22%. Charlotte's tax savings from paying the property tax is, and this is kind of what I wanted to show you, that they're trying to give you more information. For the purpose of this question, effective tax rate is the total amount of tax that Charlotte pays. The average tax rate is the average tax rate. What we're really interested in is her marginal rate, the tax that she pays on her next dollar. So her next dollar saved. You look at it both ways. It's the next dollar you would owe in tax, or it's the amount that you could save in tax. Here, so she's got $8,000 in deductible property taxes. So let's go 8,000 and her marginal rate, because that's the last rate of tax she pays. 1920. We'll think. Again, unified transfer tax system. The state tax imposes a single tax upon transfers of property only on an individual's death. Imposes a single tax upon transfers of property during an individual's life and at death. Imposes a single tax upon transfers of property during an individual's lifetime only. I'm going with life and death. You can transfer stuff while you're alive. Okay. Charlie makes the following gifts in 23: $40,000 to his spouse, $30,000 to his church, $18,000 to his nephew, $25,000 to his friend. Assuming Charlie does not elect gift splitting with his wife, his taxable gifts in the current year will be, and this is what I kind of want to draw attention to. Some of these numbers change year to year. The amount of gift you can exclude typically changes, and your brackets typically change. What we want to pay attention to is 2023. Okay, so select that. So let's go to Google and say what is the gift exemption for 2020? 17,000. He's not splitting with his wife, so really it's 17,000 times two. So 34,000. This is what I kind of want to draw attention. So he gives $40,000 to his spouse. Spouses are irrelevant in terms of gift tax. You can give as much as you want to your spouse without using any of your exclusion. So this 40,000 doesn't mean it. It's not part of our calculation. Here we've got $30,000 to his church. That's not a gift. That's a charitable contribution. He would report that on his tax return, but it doesn't go towards his gift tax. What we want to pay attention to is the $18,000 to his nephew and the $25,000 to a friend. So those are the important ones. Those are the ones that actually would count as gifts. So if we take 18,000 plus 25,000, 42,000, let's back up to 34, exemption, should be 9,000. And this is what I kind of wanted to show you with this. So they're going to give you more information than you need and some information you don't. 40,000 to the spouse, that's meant to trip you up. You can give as much as you want to your spouse. $30,000 to his church, that's a charitable contribution. They want to trip you up there. So we're going to go 9,000 because those are actually gifts. Perfect. Yeah. Which of the following statements is incorrect? Gift taxes are generally imposed on the recipient of the gift. I can tell you it's probably A. Gift taxes are not imposed on the recipient. Property taxes are levied on real estate. That's true. The estate tax is based on the fair market value of property at death or the alternate valuation date. That's also true. Excise taxes are assessed on items such as gasoline and telephone use. That's also true. So I'm going to go with gift taxes. Beyond. All the followings are classified as flow-through entities for tax purposes, except, again, there's really only one not flow-through entity, and that's corporation. Partnerships flow through, pass through, or terminology. C corporations, absolutely not pass through. Limited liability companies are, as corporations are. This one. I like the ones that have, a little more calculations. Rocky and Charlie from RC Partnership as partners. It's a weird sentence. Rocky contributes $100,000 into RC, while Charlie contributes real estate with the cost and fair market value of $100,000. Going back to, I think it was chapter 1, what you put in to a partnership it's kind of irrelevant. You're looking at the fair market value. They each put in 100,000. They are each 50% owners. Doesn't matter that one put in cash and the other put in real estate. They put in the same value. They have the same basis in the partnership. During the current year, RC earned net income of 600,000. The partnership contributes $200,000 to each partner. The amount that Rocky should report on his individual tax return is this sentence here. During the current year, RC earned net income of 600,000. Great, we need that information. The partnership distributes $200,000 to each partner. Again, it's meant to trip you up. That is irrelevant information for the cost of, or for the purposes of calculating what the answer is. What you need to know is that Rocky contributed as much as Charlie, so he's 50% of it, and they made $600,000. He should be reporting $300,000. Ryan and Edith filed a joint return showing $420,000 of AGI. They have independent children ages 7, 9, and 13. There's another child tax credit. And because this is open book, I don't love here is that they don't give you the year. I'm going to assume 2023, but they shouldn't give you the year for this question. So let's look up. Back on the full amount. Child taxes. So they're over 400,000. So it is a credit to figure out there. I know that it's typically $2,000 per child. They're slightly over the AGI. They should be 5,000. They're not zero because it's a phase out. Phase out meaning you get the full credit if you're less than this, but if you're between this and this, you get less of a credit, but you can still get credit until you pass over the ceiling of that threshold. Let me go 5,000. Taxpayer is able to change his filing status from married filing jointly to married filed separately by filing an amendment. That is objectively not true. Which one of the following items is not considered gross income for tax purposes? Cash dividends. Yes, you should report cash dividends. Illegal income. I think I went over this with Al Capone, but illegal income is taxed. Base amount of life insurance received due to death of insured. Generally, that's excluded. I'm going to click on that for now, and then gambling one that says you should report gambling. The last one, bounce around line. Child support is deductible by the payor, including the income of the payee. Not true. Child support is not a deduction for the payor, and it's not income for the payee. Negative which does not affect the payors or the payee self-reporting. Yes. The other ones, sure. Including income by the payor and deductible by the payee, deductible by both the payee and the payor and the payee. Yeah, it's not a taxable event, so it doesn't affect it. So I just kind of want to go through some questions with you, show you that they're going to try to trip you up on a few parts. Um, want you to be aware of kind of where they're trying to do that. Uh, I've got the answer key posted to Brightspace along with um, this optional exam not completed. So if you want to go through and try to do it yourself, please feel free. Should help you get a little more confident. But yep, just wanted to kind of show you guys some of the stuff that they're going to try to test you on and trip you up on. And I've got faith in all of you. All right. Thanks, everyone.